presentation. I don't propose to go through it in its entirety, but to pick out the highlights, bearing in mind this is a webcast rather than in person. I'm also conscious there might be quite a few questions at the end of this. I see there are quite a few people on the call. So we'll keep it brief and leave time for the questions. Much of what we'll cover in the presentation, you've got the ability to read in the RNS, and the questions may be more usefully answered for you. So Jog and I will split this up. We'll keep it moving quickly, and we'll pick up your questions at the end. So first, some financial highlights. I'll pick up 2 pages, picking out the key issues financially and the promise that we see in the margins in the business. Growth-wise, we've delivered another double-digit revenue and profit growth year. It's our 2014 year-end results. A key feature of these numbers is our currency headwinds. It's probably obvious to most of you, but just for the purpose of explanation, most of our revenues are generated in local currencies in a multitude of countries. We're now in 22. Those countries are predominantly euro-denominated and emerging market currencies. Over the last year, during 2014, sterling was particularly strong and provided a headwind in translating those local currencies back into reportable pound sterling. So we reported revenue up by 10%. In fact, in the local currencies, that was an 18% rise, like for like. And indeed, the headline operating profits were up by a pleasing 16%, hitting consensus profit at 11 million. In local currency, that was 22% up. We had some well-flagged increase in corporate costs in order to take on the additional acquisitions we'd made and to make us fit for purpose in growing the business through its next leg. And just turning to the balance sheet briefly, cash flow was poorer than last year as a result of a significant uptick in capital expenditure. We improved capital expenditure by about 50%, and some working capital that went into the very rapidly growing Advanced Solutions business. Net debt, in fact, we ended up with cash of about 20 million as a result of the net of the Blanco acquisition and the fundraise that we went through in March last year. For me, the most exciting part of the story, at least talking about the financials, was in the underlying margin story. Our Advanced Solutions business, which, as you know, is the higher margin, higher growth rate part of the business that we have been strategically growing over the last 3 years, grew in 2014 from 31% of the group's operating profit in 2013 to just under 50% in 2014. That, including the improvement in the margin in Advanced Solutions, has impacted positively on the divisional operating profit margin. So let me explain how that's worked. Advanced Solutions grew by just over 100% from 3.6 million of operating profit to 7.5 million of operating profit. If you take a look at the relative operating profit margins between Advanced Solutions and Depot, you'll see the Advanced Solutions business is about 3 times as profitable in margin terms as Depot. And so what you've got with the increasing percentage of those that higher margin business, if you look at the effect on divisional operating margin, and that's the operating margin before those corporate costs, you'll see in 2013 the margin was running at 6.5%, and in 2014 it's now running at 7.9%. A good uptick. Now, you haven't seen all of that drop to the operating profit line because of that step up in corporate costs, but nonetheless, there has been improvement in the operating profit line, and what we would say is that this bodes very well, given largely flat costs in the head office, for the improving margin over the next couple of years as that story unfolds. I'm just going to touch quickly on the key highlights for 2014, and then we'll move through a bit of detail on the operational aspects of the business. Depot performed much as it has been moving forward steadily in terms of the global integration of the business and producing opportunities for margin improvement coming into this year. In the second half of the year, You'll see revenues were down slightly. We took out some lower margin business, particularly in Western Europe, and margins as a whole in the second half in Depot improved. Advanced Solutions became the dominant driver of profitability, as I've just indicated, and you can see a little schematic there where you can see the pink line growing relative to the overall group's operating profit and influencing the margin as we discussed. Digital Care was a big winner for us, performing in excess of expectations in terms of the business won, which is now ramping up, and we would expect to see the full effects of that in the second half of this year. By the end of this year, we'll be the largest mobile device insurance business in Poland, with a very, very material level of profitability in that business. Blanco, I'm pleased to say, clearly a very important acquisition for us, has started well. The growth rates in that business are up versus the growth rate prior to the purchase, and actually ahead of our expectations. And finally, the global sales force, which has been a perennial feature of our positive news, has performed well again, and certainly in the first couple of months of this year is well ahead of where we were this time last year, with a significant portion of the new business budget for this year already won. Jog, do you want to touch on some of the highlights as we move through?
Thanks, Matthew. So on the depot part of the business, one of the things that we've really focused on doing is delayering the regional structure. Typically, the businesses in the last 2 or 3 years have operated one country at a time or one region at a time, and that just simply isn't relevant for the way we're now winning the business going forward. We're now winning business increasingly on a European basis, and most recently globally as well. So we've taken out the entire regional structure and gone to a more command and control approach by bringing in a bigger central team at the center of the depot. So there's a new COO that's responsible for running that, and he's supported by a number of people at the center, including a depot CIO and a marketing support. What we've also been able to do is roll out a number of central initiatives as a result of doing that. So we've rolled out our depot IT system. We're 70% of the way through rolling that out, with only Spain and Mexico left to go in. We've also been able to initiate a number of continuous improvement activities. One of them is Kaizen, and that's around reducing the repair time on a phone by identifying incremental improvements in different factories and rolling them out across the entire depot network of 15 countries. These sort of opportunities are good because it allows us to improve our operating margin in the depot business. Another way we've been able to do that is on the Excalibur software. Now, Excalibur was a business that we invested in September, and the desire of ours has been to sell that software to our customers, Vodafone and Telefonica, etc. But we've also implemented that software in our own depot business. So we're now testing all the phones and devices that come into our depot with that Excalibur software. It runs 85 tests. So when a device comes into the depot, we're able to understand within 20 seconds through an automated process what's wrong with that device, rather than doing it manually, and that manual process used to take us 2 minutes. So there's all of these initiatives will help us improve our depot margin going forward. When I come back to the numbers a little later, you'll see that the depot margin looks flat. There's some reasons for that, but my objective for the depot business is continuously improve the margin through these sort of cost-saving initiatives and efficiencies. So the depot margin was 5.4% in 2014. My objective over the next 12 months is to move that to a run rate of 6%, and it'll probably blend at about 5.7, 5.8% for FY15. The other thing we've done in the depot business is spend R&D money to invent newer technologies to move us up the value chain. So we've invested in what we called BGA repair, which is motherboard level repair, and the motherboard is the most expensive component on a phone, and we can now repair that at a microscopic level, and there's not many repair businesses that can do that around the world. The second most expensive component on a phone is the screen. We're able now to take a screen and polish out the scratches in that, and we've won work to do that globally for Nokia. That's a very scientific process, and just to give you an idea of the science involved, when we're polishing out the scratches on the screen, we're taking off 2 microns of thickness of glass, so very scientific. We're also able to invest in a technology. We've invested in a technology called RELAM and DLAM, and that allows us, and we've done this in our facility in Romania, within a clean room environment, which is an air-controlled environment, disassemble the 8 layers of the screen, replace a broken, cracked layer in that, glue it all back together, and polish it up and make it as good as new, so we can repair cracked screens now. We've also won that work globally for Nokia and a number of other insurance companies going forward. The reason we're investing in these technologies is this is where the demand is coming. You know, broken, cracked screens is the major cause of insurance claims. So we've won increasing amounts of work from insurance companies like Domestic and General, Assurian, even the operators and insurance businesses to do this sort of work. And we think that's really important for us going forward. If I turn the page on to slide 7 and talk about some of the highlights in the Advanced Solutions business. So just to remind you, the Advanced Solutions business has, for this period, had digital care in it. The digital care is the insurance business and extended warranty business. We started this up in Poland probably about 18 months ago, and it's been very much in development mode. And it's different than mobile phone insurance that you would know in the UK. In the UK, your mobile phone insurance might be a £15 price point and cover loss, damage, and theft. What we've been able to do is go to the Polish market with a lower price point product. Sort of average price point is €1 to €5. And the reason we're able to go with a lower price point product primarily is because we're not covering loss and damage, loss and theft. Loss and theft leads to lots of fraudulent claims. And so because we're only covering damage, and specifically screen damage, we're able to actually charge a lower price point because we're only covering what people want to get covered. The other thing we've done with this is we've partnered up with the 3 out of the 4 major operators in Poland, which is Polkomtel, Orange, and T-Mobile, and we're now retailing this as a white label insurance product through their 2,000 stores in Poland. We started selling this business in May 2014, and it's ramping up between May and October. We believe it'll reach a run rate, and this will be a very significant business for 2015. What's important to mention about the digital care business is we're not taking any risk on the claims because we fully reinsure the cost of these claims. And second of all, it's a good margin business, a 25% margin business, and typically we're writing 12 to 24-month insurance contracts, so it's a very stable earning stream with foreseeability leading into 2015 and 16. So we're very excited about that. I suppose the next opportunity in digital care, if we're looking a bit further out, is to roll that product, because we've now built the platform, is to roll it into adjacent countries, other emerging market territories, and we believe we could do that on a time horizon that's less than 18 months. The second advanced solution service is the IFT business. We've previously talked about an opportunity in the US where we're working with AT&T, which is the 3rd major operator in the US. We were in 2 states with them at the beginning part of the year, and over the course of the year we've increased that to 3 states, and we've grown year on year about 20%. Over the course of FY15, our expectation is we'll roll that into a further 2 states and carry on that 15 to 20% growth. We had hoped for a big bang rollout with AT&T to the whole of the US, but that hasn't happened yet, and we're unclear on the timing of that for various client-related reasons, and so we've not built that into our forecast numbers. The lottery ticket is still there. We don't know the timing of it yet. The IFT product itself in Europe has done pretty well. We've done a lot of business with Virgin Media on this, and the opportunity with Virgin Media is to now roll that product out to Virgin Media's new parent company, which is Liberty Global, and we're working with them to understand what that rollout might look like and the nature of the technology. It might require us to redevelop the IFT somewhat, but that looks very positive, and the growth opportunity there is substantial. The third advanced solution service is the re-commerce business. This business we started 12 months ago. We were very excited about it, and it had several parts of the business. What we've found during the year, I mean, we started this business with a lot of excitement, and we pretty much invented the market. When we started the business, it was probably running at a 20% margin business. And what's happened over the course of the year, particularly in the last 3 months of FY14, we found a number of new competitors have come into the market and eroded the margin I'm sure with your own research, you'll note a number of companies in the similar sort of market. And basically, the margin had declined to about 5%. And what we concluded that it wasn't a good use of our management time or working capital investment, which was significant at one point, to carry on doing this at a 5% margin business. So we've downsized that business pretty dramatically in the last few months of the year. And last year, it made a reasonably sensible contribution to FY14 profitability, and it'll be virtually zero in FY15. And we're not apologizing for that. We took advantage of an opportunity in the industry that we're in. The market moves fast. We've reacted to the change in the market conditions, and we've now focused on something else. My belief is the loss of the profitability of e-commerce in FY14 will be more than counteracted by the incremental growth in the digital care business, so we're not worried about that. If I turn the slide again to slide 8, which covers new business, it's fair to say that we started the year well. We have a global sales force of about 7 people, and they look after our top 12 clients around the globe. And these are names like Liberty Global, Nokia, Telefonica on the mobile side, and companies like Wincor and Verifone on the ATM side and chip and pin side. And our focus is on growing our business with those customers and growing them into other additional territories and or selling them new services. We've got a new business win target for that global sales team, and I'm not going to tell you the precise number, but I'll give you an indication that for that FY15 budget, 9 weeks, 10 weeks into the year, we've actually already won 50% of our new business budget, and that's better than this time last year, where this time last year we'd won only a third of it. So we've started the year in very good shape, and our focus is now closing that pipeline and implementing it. I've touched on a number of other business wins, both on the digital care side and on the insurance side, and very pleased about those. I'll pass back to Matthew. He'll talk a little about strategy and software.
Yes, in deference to time, I think many of you know the strategy. Essentially, it hasn't changed. The focus is very much on delivering 2 key deliverables to our clients. One is consistent quality of service, which comes from the integrated global network, and the other is innovation in service technology. If we can do that, we've got happy clients. If we've got happy clients, we've got recurring revenue. And if we've got recurring revenue, we can reinvest. The strategy remains to focus on the higher growth, higher margin parts of the business, which are the emerging market side of the depot business and the advanced solutions business, which, as you've seen, is a growing part of the whole. In terms of software, Blanco's landed well. We see it as a growing anchor point for a group of software services. Blanco's a well-known business-to-business software brand. We've got 60-odd salespeople around the world, which is quite a powerful distribution force. And so some of the things that we've done over the last few months has been to build that family of products that can go out under the Blanco brand. The first thing that we've announced, and I think we announced it in the pre-close, was that we upped our investment in Excalibur in July to 49% of the company. That's given us board control, and indeed we have an option for a further 11%, which would take us to 60% of the company. We've done that to gain some further control over the decision-making on the direction of the business. And one of the things that we wanted to do was to create a combined product of the Blanco Data Wipe and the Excalibur Diagnostic, and that's in progress at the moment. We believe it will be a unique product in the market, and particularly with interesting applications in the mobile side. We have just, in August, made an investment in a small investment in a company called Safe IT, which has a selective erasure capability. The difference between this and the regular Blanco business is Blanco is typically used to wipe in a certified and assured fashion assets when they have come offline, either because they're ready for repair or they're at the end of their life. Increasingly, people need to clean data as it goes to remove a specific piece of data from a large server farm. This is a unique algorithm that does that. We were the only licensee, only material licensee of that in Blanco, and we've now brought it in as we think it's going to be a winning and growing piece of business. I'm going to turn over page 11 without dwelling on it very much. There's now a development pathway for Blanco Excalibur. Most of these things will have their significant impact next year, but not this year, but they're very much part of the operating list of things to do this year. Jog, a few minutes on the financials, and then we can take some questions.
Thank you. So I think we've talked about the growth in the revenue and the headline operating profit. A couple of things on slide 12 we're touching on. Acquisition and restructuring costs are very significant in the period. We're not going to apologize for them. We've done a number of very large acquisitions and complicated acquisitions. We bought Blanco, which is in 21 countries. It was the biggest check we've ever written in terms of acquisition, and therefore we needed to due diligence that properly, finance, legal, and tax in 21 countries. We bought Digicomp in India in September, which wasn't a huge deal, but it was in India, and therefore we needed to invest very properly as part of our due diligence process. We bought a business in Russia, which was also not a large deal, but complicated in terms of the acquisition and the local requirements, and we made our investment in Excalibur. All of these things require significant investment, and we need to make sure that we are buying what we think we're buying, hence the level of cost investment in exceptional costs. We have restructured the business slightly. We talked about delayering the depot business and more of the central command and control, and we've also restructured the business at the centre very slightly, which has also contributed to the restructuring costs as we move away from being focused on depot to now incorporating a range of other advanced solution services. The tax number is worth touching on. I've guided previously that the underlying tax rate is 14% on headline operating profit, and that's what it is in FY14. The reason it looks like a credit in the period is we made quite a lot of spend on the exceptional and deal costs. We're able to obtain tax credits for that investment. Hence, it's a positive number. The longer-term tax rate of the business carries on declining as we're able to benefit from being in lower tax jurisdictions and other things like tax credits and patent box regime that now exists in the UK. And the longer-term tax rate in FY15 will be nearer 10 to 11%. So it carries on declining, which is good. If I turn to the balance sheet on slide 13, the major movement on the balance sheet has been the increase in the goodwill of about 60 million. That's primarily as a result of the acquisitions we've done in the period and mainly as a result of the Blanco business acquisition. We paid 60 million euros, and it's not an asset-intensive business. The other line items will show sort of small movements. The key movements have been in working capital. Stock and debtors investment has gone up as more of our businesses move to countries like Mexico, like India, where the working capital cycle is longer. We have been able to offset some of that investment stock and debtors by increasing our creditors, and our return on capital employed remains very sensible. On page 14, this shows a very simple movement between our net debt opening position and our net cash position at the end of the period. The biggest green block is the net cash proceeds of the fundraise after the acquisitions we've done in the period. And the graph we're touching on, the item we're touching on here, is the 6.7 million investment in CapEx and R&D. And that's a very significant investment on our part if you consider that to our 11 million headline operating profit. And the reason we've made this level of investment, first of all, we've increased it year on year by about 50%, and we're going to carry on increasing that. This is about us investing in new technology, developing IT version 2, developing software for the digital care business, doing R&D in the Blanco business and the other software businesses. And this is about us investing our profit back in the business for the long term to develop new advanced solution services that'll generate revenue over the next 3 to 5 years. And finally, on the divisional performance, I'll just touch on this for 5 minutes because this has raised a number of questions. So the depot solutions, so let me just start again. First of all, I'm going to stop reporting the split of the emerging markets and Western Europe revenue and profit. It's simply because in our business, we're now increasingly pricing on a European and a global basis, and that split is no longer relevant. So this will be the last year that I report that split. If you look at the depot solutions business, the revenue looks flat. What you need to be aware of, specifically in the Western European business, specifically in the UK, we had quite a significant revenue chunk that was a very low margin business, sort of 1%. So we decided to walk away from those contracts and not divert management time, effort, and resource running really hard to just generate 1% margin. And we closed 2 factories in the UK. The profit in the Western European business looks like it's gone backwards very significantly, much more so than the revenue. And the reason to just be aware on that is we opened up the new Memphis facility in December, the Portuguese facility in December as well, and for the emerging markets we opened Russia. Those 3 new facilities are done at specific request of global clients, and typically when we open a new facility it can take 12 months for it to reach a break-even position because it's just not got enough volume going through it. So within these numbers we absorbed £1 million of OPEX losses on those 3 new startups. So in your minds and in my mind, I'm adding back that. And if you add that back, that 1 million of losses back to the 8.1 profit in Depot and FY14, you can see the underlying number is a lot stronger. In addition, Matthew talked about this Forex headwinds. The Forex headwinds, the constant currency hit, mainly in H2, is about £600,000. That has also arisen primarily in the Depot business. So if you consider those 2 adverse movements and in your heads add that back to the 8.1, you can see the underlying Depot business is actually improving quite nicely and the margin continues to improve. The standout growth has been on the Advanced Solutions business. Most of that growth has come through organically. It's almost doubled in profitability organically, and that level of growth is definitely sustainable going forward. The margin in the Advanced Solutions business will also increase. It's increased from 12% to 16%, and our view is that that will increase further as we get more of a mix in Blanco and more of a mix of digital care in the Advanced Solutions businesses, and both those businesses are better than 20% margin businesses, so you can expect to see an uptick in the Advanced Solutions margin going forward. The corporate cost increase is cost more than doubled, but as Matthew's previously talked about, there was a conscious investment on our part for us to make sure that we're ready to cope with the level of growth that we're expecting so far, that we've experienced so far and we're expecting over the next few years. In terms of outlook, current trading on a local currency basis is in line with expectations, although the strong sterling has continued into FY15, and we expect that to continue for the whole of FY15. Accordingly, I have guided down the analysts on the FY15 numbers. I've guided them down on profit terms by about 8% in headline operating profit terms, and that's translated down into a similar reduction in adjusted earnings per share for FY15. New business wins have started the year very well, and we're ahead of the run rate for last year. And what we're expecting to see over the next 12 months is Advanced Solutions moving from being 50% of the profit of the business to nearer 60 to 65% of the profit of the business. We're expecting the margin in Advanced Solutions to continue to grow, and Advanced Solutions will be the dominant part of the business in FY15 and onwards. Opportunities for growth remain strong, both organically and by acquisition. And on a final note, we have recommended an increase in the final dividend to 2.68 pence per share, which gives a full year dividend of 4 pence a share, which is up 60% year on year. And that is very much a sign of our confidence in the future. That's the formal presentation over. I think we're ready to take questions. Thank you.
Thank you very much, gentlemen. And just a reminder to all of you watching and listening to put your questions in via the internet. We already have a number of them, some on concurrent themes. First of all, on Blanco. Steve in London is curious whether buying Blanco might actually prove to be a mistake as some of the bigger players in the sector move towards self-protection. He believes that Apple and Google have announced that they will make data encryption standard on their devices going forward, and that will protect data on the device and remove the need for data wiping. And looking at the recent significant embarrassment for Apple over the iCloud photo leaks, one might expect them to also derive an internal solution. Do you think that's a threat?
Well, I think there's 2 things here, and Jog, please feel free to join in. Encryption and deletion or erasure are not mutually exclusive things. Whilst data sits there, it may be protected while it's encrypted, but it is still definitely there. What our clients are interested in is removing any liability associated with that data. There's European legislation that is requiring that's protected. It's better not to be there at all than being encrypted. If it's encrypted, someone has a code somewhere. Apart from anything else, there's a practical aspect to this, which is as assets get passed, whether it's corporately or within a family or indeed through selling from one person to another, they must be clean of data in order to be movable and used by other people. So they're absolutely not seen as mutually incompatible. They sit side by side. It's very important. The sort of issue that's being referred to here in terms of the cloud and the vulnerability of it is exactly why selective erasure in particular is a growing and very important part of the business. So our view is that we paid a good multiple for this business. The expectation is with the growth rates that we're seeing, you could easily see the business double in profitability over its first 2 years, and it's certainly well set on that path as a result of the first few months of our ownership. And if that is the case, we'll have bought a high margin and growing margin business, which is the global market leader in its area, extremely cheaply. And certainly from what we have seen, there's a very significant level of interest amongst large corporates, and indeed Google, as an example, is a client of ours.
One other point to add to that, Matthew, is the Apple solution is very relevant for you as individuals. It's completely not relevant for you for corporates. As a corporate, you are having your employees bringing different types of devices, whether they're Samsung devices, Android Samsung devices, Apple devices, and we're just talking about mobile phones. You've also got to encompass tablets, you've got to encompass your laptops, and they're of different brands like Acer, IBM, Lenovo, etc. As a corporate, you cannot rely on the individual to delete the data at the end of the asset's life. You need a corporate solution. 50% of Blanco's revenue is to corporates, and they need a one-stop solution that encompasses all different device types and all different OEM brands, and the Apple solution simply isn't capable of doing that.
I think it's a good point, Jog. The second aspect of that, which I didn't really touch on, was the new European legislation, which, by the way, purports to apply to anybody outside of Europe that's doing business in Europe. So it's quite encompassing. Requires not only that the data is erased, but the process by which data is handled is tracked, and that there is an audit trail for the erasure. So interestingly, if you go onto the internet today, you can get perfectly good erasure software free on the internet, and indeed Blanco has a site designed for consumers which offers a dumbed-down version of its software to consumers. What it doesn't have is the audit trail, which is a complex thing, and that is what the corporate's buying, because one, they're required to legally now, and two, it's actually what they need for their own assurance. Perhaps we should move on.
Yeah, well, actually, just linked to that, a question from Ruth about the implementation on the EU legislation, how it is likely to proceed this year, and whether you expect that to lead to an immediate surge in Blanco sales, or whether it'll be gradual adoption by the larger corporates.
What we do know is that implementation is required in member states over the course of the next couple of years. Talking about the UK in particular, the mood music is that it will happen early here. We'd like to be seen to be leading the pack. I think it's better to be cautious and assume the uptick is a gradual one. Adoption of new practices tends to be slower than you'd like. But what I can say is that large corporates are now beginning to worry about this issue. Our own forecasts and projections, either for the purposes of this year and next year with Blanco, or for the purposes of just simply making this a sensible deal in terms of the price we've paid, do not depend on some sort of big bang occurring. We think that's the groundswell that's producing the general uptick in sales that we're experiencing at the moment.
There's also a video on the Regenersis website in the investor section, and this is specifically a video where we've filmed some industry experts that know about the data regulation. It's a 4-minute video. I'd encourage you to watch it. It'll give you a bit more information about the new legislation coming on board and how Blanco is set up to support corporates in applying and complying with that legislation.
Okay, thank you. James queries, the significant share price decline in the last couple of days is much greater than the quantum of profit downgrades that have come from analysts. Hindsight is a wonderful tool, but looking back to your July update, confirming that the historic year was in line with market expectations, would that not have been a chance to warn in advance about the currency impacts?
It certainly was a chance to do that. We didn't do that because at that point we were overcoming the headwinds. And just to put this in a very practical sense, and for those of you that aren't accountants, what that headwind means is that in order to produce a 16% growth rate, as we have done this year, with an 8% headwind, we actually needed to produce about 24% of growth. The disparity between those two numbers in corporate terms, you'll all be very aware, is very, very significant. So in fact, we were overperforming in constant currency last year in order to deliver the consensus. And in July, we didn't have a view as to 2015. We were continuing to overperform. I think sitting here in September, I can't prudently tell you that we will achieve the sort of 24% growth in constant currency we need to do in order to hit what is 17% sterling reported profit. Not to say we can't. We did last year, but at this point I can't tell you on balance that that's what's going to happen, which is why we guided to the level that we have, which frankly is just saying that we will continue to deliver what we expected to deliver. Unfortunately, it's just less in pound notes.
Okay. A couple of questions online. Obviously, yeah, the share price fall has taken everyone, some of them by surprise. Certainly the extent of it, and Jog, you detailed the fact that in the numbers for full year 15 were nudged down by sort of 8%. Can you expand on the implications for the full year 16? And perhaps within that you can incorporate just where you've adjusted your profits and the earnings.
Yeah, so the main adjustment in the profitability for FY15 is solely down to Forex, where I've guided down on headline operating profit and adjusted earnings per share by 8%. That impact is mainly in the depot. Even having guided down by 8%, the growth that we're expecting between 14 and 15 in headline operating profit terms is 47%, and that's mainly as a result of the Blanco acquisition. If I look at the growth expected on adjusted earnings per share between 2014 and 2015, even having guided down 8%, the growth that we're going to deliver is 11% in adjusted earnings per share. Now, it's 11% rather than the sort of 18 or 20% that we're delivering historically, and the reason for that is we did a placing in April where we raised more money than we needed, and we've got 40 million excess cash from that placing that we haven't invested yet, and therefore we're not earning the benefit in our earnings yet, although it's dragging down the adjusted earnings per share because there's a bit more extra shares out. In terms of FY16, we guided on FY16 for the first time now. The consensus number guided to the analysts shows a headline operating profit growth between 2015 and 2016 of 18%, which is very credible and in line with what we've been delivering for the last few years. And in the growth on the adjusted earnings per share between 2015 and 2016 is also 18%. It's also very credible.
Last one for you, Jog. The return on capital employed looks weak. Why do you think it is?
If 70% is weak, then I'm shocked. I mean, there's a number of businesses out there that I'm not going to mention their names where they consider 20% good. 70% is an excellent return on capital employed. It has declined a little bit, and it's declined from 99% to 70%. So I don't agree with the comment that it's weak. It's just worth touching on that. The return on capital employed different parts of the business are very different. So in the depot part of the business, the return on capital employed is about 60%, which is very credible. In the advanced solutions business, the return on capital employed is well over 100%. And as the advanced solutions part of the business continues to grow and be a more dominant feature of the profitability going forward, I expect the return on capital employed to increase further.
Okay, thank you both of you for your very transparent answers. Thank you to our audience. Again, we would reiterate there is a lot of information available on the Regenersis investor page on their website. And for those of you interested in technology companies, there is another lunchtime webinar tomorrow with KBC. Thank you.
Thank you very much.
Thank you.